Welcome to FOMO Consulting for your daily AMC stock analysis video on Saturday, May 1st. Ladies and gentlemen, next week could be huge. We have some major catalysts in the upcoming week that could play out very well for us in the very near future. We won the 10 battle war this week. We closed at $10.03. And as always, the apes are winning, the diamond hands are winning, and the retail investor are winning. So if you find this video informative and entertaining, please like, share, and subscribe. It's a newer channel and I would certainly appreciate the support. Let's get into the video. So first and foremost, I want to thank everyone personally who has liked, shared, commented, and subscribed. I cannot thank you enough from the bottom of my heart. So quick quote, if you don't think about the future, you can't have one. From my fortune cookie that I ate last night. But it's very relevant. We are all thinking about the future. We are all waiting on the short squeeze. We all believe there will be a short squeeze. We believe it will be life-changing in many ways. We are all dreaming about the future, and I do believe we will all have a very bright one and lucrative one in the very near future. Quick review of yesterday's broader market. All three major indices were down. Absolute bloodbath. Technology got hit yet again. AMC stock, no doubt, was affected by that, but I could not be prouder of the levels that we maintained. We own the $10 floor, and we resisted the downward pressure from the broader market. So the movies are alive and well. Don't let them tell you otherwise. Mortal Kombat. 51 million worldwide, 23 million domestic through yesterday. Demon Slayer is rocking it at 422 million worldwide, $28 million domestically. Godzilla vs. Kong, $407 million worldwide, $87 million domestically. Absolutely huge numbers, even with limited capacities. The movie theater is alive and well. AMC is alive and well. So let's look at the stock chart from yesterday. No doubt they tried to get it below $10. They are trying to keep a lid on our stock, keep it from short squeezing. We'll get into that very shortly. We did close at $10.03, down 1.67%. It is the best down day we've had in quite a while. It's reminiscent of the $8.01 day. We absolutely showed our strength, and we did win the battle. So AMC stock daily chart versus the overall three major indices somewhat mirrors the action throughout the day. No doubt AMC was affected somewhat, especially with technology and some of the consumer discretionary stocks, ETFs, that sort of thing. We were certainly affected by that, but overall we performed very well. So one of two major catalysts this week that could be absolutely huge for us. This is the Q1 earnings report. It will be Thursday, May 6th, 5 p.m. Eastern. This could be huge. We could have a big run up to the earnings if we meet or exceed the earnings. Look out, right? Look out. And I believe, quite frankly, the shorts will try to exit some of their positions leading up to that, and I'll show you why here very shortly. Additionally, we have the annual shareholder meeting, May 4th, well documented. At either one of these two events, we could hear about the share recount numbers, which again would be a huge catalyst, I believe. So both of these events this week, I think, are very important to the very near future and the potential short squeeze. So again, 8K filing. Overall, you can do your own due diligence, but the current estimated EPS averages a loss of $1.26. That is nearly $2 per share better than the Q4 earnings. And last year, AMC negative $20.88. If anyone says this company is not recovering, I'm not sure what they're looking at, but it is clearly trending in a positive direction. The company is recovering. Obviously, we know about the debt and all the different factors, but the reopenings, the movie titles, the blockbuster movies stacked up for the summer, this company is well on its way to recovery. Quick view of the daily chart over the last couple of months or so. We've been here, done that. If you look at where the green arrow is on the left, prior to our run up to $14, we had a nice juicy green candle, then followed up by 4 red days, broke below the moving average. You look to the right, did the same thing, juicy green candle Monday, 4 red days, broke below the moving average. We are in a bullish MACD crossover. Hopefully all of that will maintain. I do believe Monday will be a green day, and I'll show you why very shortly. Again, indicators are all positive, bullish MACD crossover, moving averages still in a bullish sentiment. As long as we maintain that, I think we'll be just fine. I am anticipating personally a green Monday. I am anticipating a green week overall, assuming earnings come out and they meet expectations. I think we could have a fantastic week, and it could be a huge week, quite frankly. The red lines basically show, and it's for illustration purposes only, not technical analysis, but it shows the range that we traded in this week, and we have traded in this range for quite some time over the last few months. Between that 10 and 11.50 range, $12, we've bounced through that channel many days, many times. I believe we will hopefully get close to, if not break out of that channel this week, depending on the news and the earnings and that sort of thing. But I do believe we are in a very good position right now. I know after 4 red days, everybody kind of gets a little doubt in the back of their head, right? But when in doubt, zoom out. Again, not technical analysis, but it is clear we are still on an uptrend. As long as we maintain that uptrend, I will believe in this stock, and I'm sure you will too. Short data increasing by the day. Cost to borrow fees going up. Days to cover, we are 1.24, which is huge. In my opinion, that really means we're in the 3 to 4 day range, depending on how you calculate. Shares on loan went down just a hair, and I'll show you why that's important. The free float on loan went down just a little bit. I'll show you why that's important, in my opinion. Estimated short interest, still very high. Went down just a bit, but again, I'll show you why I believe that's important. And utilization is still at 100%. One more institutional buyer bought in. I believe that is also relevant. 26 million on the volume yesterday, very low, lower than even our recent averages. Short shares available, believe it if you want, with Fintel, 150,000. Short borrow fee, 15.03% with Fintel. There is a discrepancy between Ortex and Fintel simply because of where they draw their data from. So I showed this yesterday, brief review. The last earnings report was absolutely crucial for us. So what you're looking at is from Ortex. This is obviously the price action daily chart. This goes back about 3 months, give or take. And what you see here are the cost to borrow, the shares on loan, the free float on loan, estimated short interest. All of that is very relevant, and the days to cover 2 weeks estimated. If you look at the first earnings report, as we ran up, they no doubt started covering, at least partially. That allowed us that week and shortly thereafter to go up to 1450. You can certainly see where they pulled out of their position by the trend lines. That took a sharp nosedive, but they immediately got back in the game and started reshorting, and I'll show you that in more detail here very shortly. But if you look, we are double where we were at that time on short interest, all the short data. We are leading up to the earnings this week. If earnings come in very positively, or even the estimates appear to be positive, I do believe the shorts will get out very quickly. I believe they will start covering, which could launch us even higher. If you look at the recent trend lines over the last few days, they are going downwards. I believe there is some covering, some exiting out of their positions already, and I'll show you why that's relevant shortly. So yesterday, why it was so important to close above 10, there were nearly 15,000 contracts at the $10 strike on the call side, which means potentially, just like this past Monday, we could see some green buying pressure shooting us up, and I believe that's very positive. So about 15,000 contracts was huge to close above $10. So this is the chart for TCAT, and if you recall a few weeks ago, TCAT came up, ran up really hard. So a few things to note on this chart, and we're going to look at a few others, is the gray volume bars in the middle of the screen. Those are the security lending volume bars, basically the volume on borrowed shares. So understanding the opportunistic nature of the short sellers that we're in battle with, you can see where when the price spikes, they immediately jump in heavily and short it down. Additionally, you can see prior to the little pump, there was not a lot of heavy short interest involved. It wasn't, like GME or AMC or anything else. But what's always seems to occur is the short interest trend lines generally find a way to intersect with the price near the top. Not always exact, but it's certainly something I'm finding more and more prevalent. But as you can see, as the price came way down, they exited their short positions. There was some covering. You can see the volume went way down. The price starts going back up, likely because of some of the covering. They jump right back in, borrow more shares, as you can see on the far right-hand side of the screen. So let me show you another chart. So let's look at MBIS, popular little stock lately, pumped just this past week. So let's start on the left. Gray volume bars. Already some borrowing of shares going on, right? The trend is starting to go up from a short interest perspective. The price begins to rise a little bit. Somewhere right around the January timeframe, the short interest shoots to the moon and goes way up. Shortly thereafter, the price jumps. The orange bar at the top is around the height and trend or average trend of where the short interest peaked. The yellow dash with the red X is where the price pretty much met that trend. So there is some correlation between the amount of short interest preceding a pump, and I'll show you that very shortly. But it seems that the price always seems to chase up to the level of the short interest. Obviously, if you look at the chart, as the price started to rise, the shorts started to exit their position. They covered. You can see the green pump, but they immediately started, by the volume bars, started borrowing more shares to short it right back down, right? And you can clearly see that in the price action. And rinse and repeat. They did it again. The short interest starts rising again over to the right, up to this week. It got extraordinarily high for this particular stock, higher than the last one. And what happened? The price spiked and met that general range of the short interest trend. Obviously, there's always a catalyst needed, but one other item of note is the green arrows shows a extreme divergence between the short interest and the price action. When there appears to be a large void, between the price action and the short interest trend lines. For whatever reason, the price seems to pop shortly thereafter, and the price rises to meet the trend line of the short interest, and I'll show you shortly. So this is BlackBerry, popular stock, right? This goes back about 6 months, leading up to the squeeze in January. You can see already some borrowed shares going against it. Price peaked a little bit, they exited. Green arrow, big divergence between price and some of the short data trend lines. Then the price starts moving up. The price point meets the short data trend lines, as evidenced by the red X. That's where they both converge. Immediately, the shorts exited their position, obviously. As the price got higher, they started to cover. They immediately started borrowing shares to short it and write it down, basically hedging. So the price fell off very hard, and as you can see over to the right, they began the process again by heavily borrowing shares against BlackBerry, but there's also a substantial divergence building. We'll see what the future brings. This is Tesla. Very, very popular shorted stock. We all know the history. It has been basically a year-long squeeze. Started, in the $30–40 range or whatever, and peaked around $900 a share. This chart goes back about 6 months. So again, if you look, big divergence between the short interest and the price, green arrow, heavily borrowed shares right before. Price runs up, shorts exit their position, start covering, immediately borrow more shares to write it back down, rinse and repeat, right? But the price met the short interest trend lines. It seemed to chase it and follow it right up, right? So let's look at GME, GameStop. So starting on the left, look at the extreme divergence between the price action and the short data trend lines. Obviously, as the price started to run up, shorts started getting out, started covering. We all know the story. It shot to the moon, $480 something, whatever. But what's fascinating about this is you look as it's squeezing, the shorts immediately start borrowing tons and tons of shares to write it back down, as evidenced by the gray trend, the volume bars right at the time of the squeeze. So they're exiting and reloading all at the same time. And again, price met the trend about $483. And it was such a violent squeeze, and we all know the buying issues with some of the platforms. I do believe that the price point would have been up into the 700s based on what I'm looking at and what I've found. But again, you can see again at the more recent, let's just call it the baby squeeze in late March, you can see the divergence between the short data or short trend lines and the price. There was a pop, right? So again, I think there may be some relevancy to this. You do your own due diligence. I'm certainly not a financial advisor, and this is not financial advice. So let's look at our baby AMC. So you don't have to be a rocket scientist to understand what this is telling you. Obviously, there were a lot of borrowed shares prior to, and this goes back about a couple of months. So before the March earnings call, where we reached $14.50, you can see where the short data trend lines were heading up with price until we got to the breaking point. They exited, they started to cover, as evidenced by those few hard green candles that led us up to the 14 range, but go figure, immediately they borrowed shares to short it right back down. The FUD machine kicked in. We all know the story, and it has been pressed down ever since. But if you look at the borrowing at that time, as we are rising, they are aggressively trying to force it right back down. Where I think they've made a huge mistake is right past that point, as evidenced by the short data trend lines that are escalated to the point we are today. So this is a little closer look at AMC. This goes back 1 month. So the yellow bar right in the middle is pretty much right over the 100% utilization trend line. So the recent pump we had this week, you can see where the short interest in the short data and certainly the borrowed share volume. They shorted it to get it right back down, and you can clearly see that. The problem is they are out of shares. There is not many shares to borrow because we're at 100% utilization. They are out of ammunition. They can only recycle what they have, which makes me exceptionally bullish leading into this week. Going into earnings, I believe we could really cause them some pain this week. So you don't have to, again, be a rocket scientist to figure this chart out. This goes back 6 months before the baby squeeze. Short data trend lines, you can clearly see we are on the uptrend. We are 3 times more than right before the baby squeeze in January. We were around, let's say, 50 million shares on loan. We are now at 150 million. We are 3 times the levels before the baby squeeze. So let me dig into this with my little illustrations one more time for AMC. So you can see at the time of the baby squeeze in January, had a lot of borrowed shares against as the price jumped up. Obviously, they exited their positions, started to cover, price jumped up. If you see the one really strong gray candle that is near the top of the by the yellow bar and the red X, that's where I believe their first mistake was. I believe they borrowed, in my opinion, about 50 to 60 million shares that they still can't get rid of. I believe they over borrowed because they believed the price would continue to go up. When there were issues, obviously, with the trading platforms and people couldn't buy, I believe they are carrying a lot more borrowed shares, as evidenced by the fails to deliver, and they just can't get rid of them. The second mistake I believe they made was they overshorted us at the $14 level. When they exited their positions when it got near $14 and tried to reshort it, again, I believe, as evidenced by those very tall gray volume bars, they have again overshorted the scenario. Thereby, they're carrying a lot of borrowed shares they cannot get rid of. Additionally, you see the trend lines continue to go up daily. And now we're at a point, if you see the orange bar on the left at the top right and the price action, we have a huge divergence. Every stock I've looked at that has that huge divergence between the overall trend of the short data and the price will find the data trend lines. So this again is very important. Big money trades. So this is yesterday on the options chain. Largest trades, a May 21st $29 strike call, nearly 1,000 contracts. May 14th, $11 strike, nearly about 850. These are huge numbers, folks, and I'll show you here very shortly some additional data around this. Options are still very bullish, 2-to-1 ratio, give or take. We are in a very good spot from a options sentiment perspective. I do not trade options, but I'm looking at the IV. I'm looking at the sentiment. We are definitely in bullish territory. So this is from my personal Fidelity account, and I just wanted to bring this up because I was showing some different scenarios and understanding a little better why the shorts are involved in versus the longs, and where the profitability lies and where the opportunities lie. And this was an interesting dynamic here. So I could have purchased, not that I did, and I didn't, a June 18th $11 put. My estimated income from that would be 250 bucks. Okay, great. So alternatively, a June 18th $11 call, give or take same strike area, $146. So looking at the put data for that range, which is extraordinary to look, there is over 15,000 open interest contracts at 50 cents. I am pretty sure, I'm not an options expert, but I'm pretty sure this is extreme hedging. No doubt they are heavy on the long side, but these numbers were eye-popping. 15,000 at 50 cents, $1, nearly 14,000 contracts, $2, 22,000. What, 60 days out or so. So these are extraordinary numbers this far out and that low of a strike. Additionally, on the call side, there's some huge numbers as you go up. At $15, you have 25,000 contracts. $10 strike, 30,000 contracts nearly. Huge numbers, right? So obviously, the scenario that my Fidelity account was showing me is certainly a valid one. As always, ladies and gentlemen, I am personally invested in this very heavily. 4,822 shares in my Fidelity account, 630 in my Weevil account. I am in this diamond hands along with you. Yes, I was bleeding money yesterday with you and have most of the week, but I am in this to the bitter end because I believe in where we are going. So one final quote: everybody's got to believe in something. I believe I'll have another beer. By comedian W.C. Fields. I believe in AMC. I believe in the company. I believe in the stock. I believe in what we're all doing. I believe in buying and holding. And I believe I'll have a great weekend, and I hope you do as well. And I believe we all deserve a beer after closing at 10:03. So, ladies and gentlemen, I hope you found this video informative and entertaining. And if you did, I would ask that you please like, share, and subscribe. It certainly would mean the world to me. And as always, I hope your life is full of green candles.